Treasury yields took a day off from the volatile trade that we've seen over the last several weeks. We kind of got a sideways trade hovering near 2.5%. We recall we got those lows in not too long ago south of 240. And the idea here was that there was a flight to quality bid in the market, perhaps a positioning trade. We saw the market get way oversold and turn around, and then everybody started buying, and we saw this massive reversal. Well, that has in turn reversed again. So after putting in those lows, we've seen the bond yields certainly rise rather quickly, but it seems to have taken a little break today as we trade sideways. Not a lot of news to move the market today, but we do have some news coming up, and we'll talk about that later. And if we look at market volatility, as the market was being bought, as those yields were being pushed towards the lows, we saw volatility spike, nearing the year-to-date high. Not quite getting there, but nearing the year-to-date high. And since that day, we've seen yields retrace back up into the old range. We've seen yield volatility go down towards year-to-date lows. So it's been a very quick move, higher and lower volatility reflecting that. Obviously, it becomes a very directional trade as yields trade lower. We see vols bid as yields go back higher, back into the range. We see volatility decline. So right now, we're seeing a sideways trade. Yes, looking ahead, we still continue to look at China and trade talks. How will they be resolved, if at all? Likewise, we have inflation data coming out this week with the CPI data. That is always on the Fed's radar. And lastly, we have the FOMC minutes from the March meeting. And we recall, March was very much a turning point for yields. We were trading around 255 in yield when that announcement came out back on March 20th. We saw yields decline as low south of 240. Now, yeah, they're right back to just below that level at around 250, but I think certainly the market is anticipating a no-go Fed for the remainder of 2019 with the idea that a cut might be coming in early 2020 if the economy itself doesn't turn around. So right now, the minutes become the focus point of this week, and I think if those dovish tone is amplified via the minutes, we could see yields turn south very quickly. Likewise, I think it becomes a stock market trade. If stocks start to falter, you'll start to see some of that money move roll into the bond market or into the riskless assets. I think gold prices are probably a little bit low here given the trade we've seen. So I think yields right now at 250 could be topping out if the minutes prove more dovish, and if that data doesn't prove to be higher inflationary and more growth, which is something the Fed needs both of right now that they haven't seen. And that's one of the reasons why we've seen those numbers and those expectations for rate hikes falter. Look out, 2019 could see a rate cut in the fourth quarter, but that is yet to be seen.